It feels like the economy and markets are living in different worlds right now. On the one hand, the global economy is facing a complex set of supply shocks. These create a confusing and different environment versus what we have become used to. Oil price spikes, ongoing disruptions in commodity supply, and intense geopolitical uncertainties. Fiscal policy has taken over the lead from monetary policy in much of the West, plus the China shock too, with a surge in high technology exports to Europe and the rest of the world. And alongside all of that, we have a once-in-a-lifetime AI investment boom with the huge capex plans of the hyperscalers. It means a lopsided growth picture with winners and losers, the so-called K-shaped economy, a spikier profile for inflation, with energy and compute prices sharply higher, and also a shifting situation for central bankers, with hawkish thinking on the rise at the Fed and elsewhere. But against all of that, the situation in investment markets, that looks calm. Markets have been able to shake it off. Stock markets have rebounded at high speed from the geopolitical drawdown in March. Overall market returns in the first half of the year look good, especially in the context of the headlines of 2026. They look really good. Emerging markets in stocks, bonds, and currencies have been resilient to risk-off conditions. And then leaders in the market rebound, with Asia tech and LATAM resource stocks performing. So you can see why it feels like the economy and investment markets are living in different worlds. So what's going on? And who's right, markets or economists? Well, that might not quite be the best way to phrase it, because two factors can maintain the current equilibrium. First, corporate profits. Now, these have been gangbusters in 2026 so far, one of the best US profit seasons in investor memory, and big profits upgrades too. In areas like tech, profits expectations are stellar for the rest of 2026. Almost 40% this year for NASDAQ and 50% for Asia ex-Japan. So all of the supply shocks haven't disrupted the profits outlook so far. And a high nominal GDP world has protected performance for stocks and for credits. So if that continues, then markets can stay resilient. Second is the discount rate. Despite spikeflation and rising expectations for policy hikes, despite fiscal worries and global bond yields moving higher, other discount rates haven't come under pressure. In fact, PE valuations in the low 20s for the United States and 12 times for emerging markets, they continue to look okay. Yes, it's true that equity premia aren't as high as they were, and that does constrain medium-term returns. But higher yields in bond markets is mostly about inflation. Real yields remain quite stable, and that keeps the valuation arithmetic okay for now. The combination of supernormal profits and a stable cost of capital, that's what's keeping market volatility low, even with all the bad headlines. Okay, so looking forward, what should investors expect in the second half of the year? Well, the macro landscape remains confusing and complicated, but it's important to recognize that markets have been able to progress despite the bad news in 2026. We have climbed the wall of worry in investment markets for good reason. Today's supply-driven economy means that it's going to be a bumpier journey, however, and investors should prepare for that. So expect episodic volatility in markets, but don't adopt a risk-off stance just because of the bad news headlines. Oh, and watch profits really closely. The situation in 2026 is very different to 2025. Inflation and hawkish central bankers are back. The dollar is not weakening like it was, and growth momentum is more uneven. But market performance can still broaden out. Continue to position for the AI megatrend, yes, but we also like the opportunity in emerging markets best. A large tech exposure, strong profits, sensitivity to a weaker dollar, and still neglected by global investors. So it doesn't just have to be about tech. We would look at areas adjacent to technology, upstream and downstream from the investment boom. And these areas can benefit from the productivity and growth boost. So this would include infrastructure, materials, industrials, but being careful not to overpay for those themes as well. It is broadening out 2.0, focused on areas of the AI spillover. And finally, diversify the diversifiers. It still remains one of my favorite phrases to navigate today's environment. But higher yields in bond markets also means that income opportunities have improved across fixed income and in defensive equities too. So we think investors should look again at diversified income, a basket of yielding assets from G7 bonds to working capital private credit, from infrastructure to the equity income factor. That income can add some important ballast to portfolio returns. And I think that's an important feature to successfully navigate today's different world.